The big story this year in US markets has really been inflation, and then as a result of the inflation, the Fed. So I think the first part of the sell-off in the US market was really related to what I would call policy normalization. Now there's increasing concerns that the Fed is going to raise interest rates too much, and we're going to see some sort of more pronounced slowdown in economic growth. Yeah, so the U.S. economy is still the largest economy in the world. So obviously what happens in the United States has an impact on the global economy and global financial markets. So I think it's reasonable to assume that some of the economic slowdown that we're seeing here and we expect to unfold in the United States and some of the headwinds that the U.S. equity market are facing, those will have an impact on the rest of the world. So we are in the soft landing camp. In other words, we don't think we're going to have a recession. It's a little bit of it's a trade-off between inflation and economic growth. They want to try to avoid a recession. So I think they're going to err on adopting policy that will err on the side of avoiding the recession.
Hello everyone, welcome to SFC Markets and Finance.
Since the inflation remains elevated, the Fed has raised interest rates by 75 basis points at June FOMC meeting. In such challenging environment, is the U.S. economy heading toward a recession, and what should investors do in a volatile stock market?
Let's welcome David Lefkowitz, the head of U.S. equities at Chief Investment Office at UBS Wealth Management, to join our discussion. Hello, David. Glad to see you.
Hi, my name is David Lefkowitz. I'm head of U.S. equities in the Chief Investment Office at UBS Wealth Management. Very happy to be here. Happy to talk about all things happening in the financial markets and the U.S. economy. Looking forward to the conversation.
First, let's start with the U.S. stock market. The U.S. equity market has been volatile lately. What are the reasons for the corrections?
Yeah, I mean, I think there's been a couple of reasons. First, the big story this year in U.S. markets has really been inflation, and then as a result of the inflation, the Fed. So I think the first part of the sell-off in the U.S. market was really related to what I would call policy normalization, meaning the Fed beginning to raise interest rates to a more normal level, and longer-term interest rates also rising to more normal levels. We've certainly seen interest rates rise at the longer part of the curve, longer-term treasuries. And that had a negative impact on stock market valuations, especially because stock market valuations they were definitely well above average when we started the year. And they were predicated on these very low interest rates that we had in 20 and 21. And now that interest rates are normalizing, you're seeing valuations come down. I think the second leg of the sell-off has also been related to now there's increasing concerns that the Fed is going to raise interest rates too much, and we're going to see some sort of more pronounced slowdown in economic growth. So I think it's been sort of two elements: first, policy normalization, and now more recently, concerns that we're going to see a slowdown in economic growth in the United States.
Some believe the stock market is in a bubble akin to 2000 that is in the process of deflating. What's your opinion?
Yeah, I don't think the stock market was in a bubble. I think, look, it's clear that valuations were higher than average, and now we've seen a good amount of correction now. Just to give some perspective, when we started the year, the S&P 500 was trading at 21 and a half times earnings. That's a way that we measure how expensive things are. The long-term average is about 15 and a half, so it clearly was elevated. But as we speak today, that's come down now to about 17 times. So, a lot of the overvaluation has been worked off. I would also say a couple other things. We certainly did see some speculative behavior in recent years, in the last couple of years. But it was more concentrated in small parts of the market. It wasn't nearly as pervasive as we saw in the dot-com period when that speculative period lasted many, many years, and it really pervaded the entire stock market. Today the pockets of more speculative behavior were more isolated. But look, I would say I just want to underscore that there was valuations were a bit elevated. And they're still, as I said, a little bit higher than normal. And so I think from here, investors should expect over the next 10 years, maybe returns of 6, 7, 8% in US markets. That's going to be very different than the last 10 years when the S&P 500 was up about 15.5%. So we do have to recognize that valuations still are higher than average. And as a result, returns will be a little bit below average.
UBS lowered the year-end S&P 500 price target from 4,700 to 4,300. And in the recent report, you mentioned there are plenty of headwinds that could put further pressure on US equities. So what are the critical factors that will affect the stock market in the following months?
Yeah, so I think this is inflation. The reason that the Fed is hiking interest rates really has to do with trying to get inflation under control. So to the extent that we see, continue to see elevated inflation, that means that the Fed, the Federal Reserve, central bank in the United States, is going to continue to raise interest rates. And as we talked about, that's going to have a bit of cause a bit of a slowdown in the economy. And the other thing that I think is also important is oil prices. I mean, clearly they have shot up quite dramatically. And actually gasoline prices have moved up even more than oil prices than you would expect based on where oil prices are. So that's also a headwind for the economy and for consumer spending, especially consumer spending on more discretionary items. So I think the key things that we're watching are what's happening with inflation, how high is the Fed going to raise interest rates, and then ultimately what kind of impact on economic growth is that going to have in the quarters ahead, and especially as we think about 2023.
How will a bear US stock market affect global financial markets?
Yeah, so the US economy is still the largest economy in the world. So obviously what happens in the United States has an impact on the global economy and global financial markets. So historically, there has been a good correlation between U.S. markets and non-U.S. markets, just because the U.S. economy is so large and the U.S. equity market is so large. So I think it's reasonable to assume that some of the economic slowdown that we're seeing here and we expect to unfold in the United States, and some of the headwinds that the U.S. equity market are facing, those will have an impact on the rest of the world. Now, I do think it's probably important to highlight that, to a little bit of extent, China is a little bit less correlated with global equity markets because it is a little bit more isolated from some of the same trends that are happening in the United States and Europe. But yeah, I mean, the U.S. economy and U.S. financial markets are so large, it's also an incremental headwind for most other parts of the world.
What is your prediction of global financial market in 2022? Which region will perform better?
Yeah, so we actually don't have a regional preference right now. And I would say our highest conviction views are more on the sector and style side. So we talked about energy, we talked about healthcare, those value stocks. Yeah, again, I think focusing on real assets, commodities. So we do have a preference for Australia and the United Kingdom from a regional perspective, but it's kind of a reflection of our view that investors should have exposure to commodities. Both of those equity markets have strong exposure to commodity producers, commodity type companies. And so it's kind of a reflection of it's still going to be an environment where commodity prices are going to be relatively high. And we think that's some ways to gain exposure to it. But I would emphasize, I think we have more conviction in some of the sector calls, energy, healthcare, and then clearly focusing on value stocks.
Would you like to give some suggestions to investors? What sectors will have more opportunities?
Yeah, so right now there's a couple sectors that we do like. We've had actually a long-standing view on a positive view on the energy sector that has worked really well. We put this on over a year ago, so this was before the war in Ukraine. From our perspective, it's likely going to be a pretty tight oil market for some time. I mean, we haven't. If you look at the data, we're now on the 8th year of relatively low investment spending on new energy exploration and production. And the simple truth is that it's because there's been such low investment spending, it's really challenging for companies to increase oil production, and that you can't just turn that on a dime. So I think we are going to be living in more elevated energy prices for some time, and that's pretty supportive for the energy sector. We also like healthcare. This is an area that is is more insulated from some of the headwinds that we see for the economy. People don't typically. People spending on healthcare doesn't typically move up and down very much, depending on the economy. Because if you need to go to the doctor or you need to take drugs, you do that regardless of whether or not you have a job or not. So we think this is also an area that is interesting, and it's one of the cheaper, more defensive parts of the market. And then we also like value stocks. We've also liked value stocks also for well over a year, similar to energy. I just think it's going to be a very different environment for value companies. They were out of favor for a long time, for basically 10 years. But part of the reason they were out of favor was because we had low interest rates and low inflation. Value stocks do well when we have higher than average inflation and generally rising interest rates. And I think that's the environment we're going to be in over the next few years. So, just summing it up, I think there are some pockets of areas that do look interesting: energy, healthcare, and value stocks more broadly.
The Fed appears determined to fight inflation. Do you think they will raise rates as much as they stated? Will the Fed be more aggressive?
So we're looking for the Fed to raise the federal funds rate this year to a range of 2.75% to 3% by the end of the year. I mean, that's pretty close to what the market is already expecting, and probably more or less in line as we speak today, more or less in line with what the market's thinking. Like I said, close to 3% by the end of this year. At that point, we think it's possible that the Fed pauses interest rate hikes, but obviously we'll have to see how well inflation is behaving at that point.
Will a more hawkish Fed be able to ensure a soft landing? Will recession take place?
So we are in the soft landing camp. In other words, we don't think we're going to have a recession. And I think there's a couple of factors that give us some comfort that the Fed can achieve a soft landing. And first and foremost, the Fed itself is very aware of this risk. And they have what we call a dual mandate. Their dual mandate is stable prices and full employment. And if they start to get worried about full employment, in other words, if the concerns about if people start losing their jobs, or if there's a greater risk that people start losing their jobs, I think you'll see the Fed react very differently. So like I said, the Fed is very aware that this is sort of their decision at the end of the day. It's a little bit of it's a trade-off between inflation and economic growth. They want to try to avoid a recession. So I think they're going to err on adopting policy that will err on the side of avoiding the recession. The other thing is that, consumers inflation is high, and that's not good. But more broadly, consumers are in pretty good shape. When we look at consumer balance sheets, they don't have a lot of debt. Also true of the business sector, the corporate sector. So that's another reason that we don't see a lot of imbalances. The other thing is that, on that point, businesses haven't really overinvested in large parts of the economy. This is a very different story today than, for instance, what we saw back in the housing bubble back in 2006, 2007. Also very different than the dot-com bubble in the late 90s, when there was just massive overinvestment in large parts of the US economy. We don't really see that today. So for a number of reasons, we think consumers and businesses have some cushions that they can get through some of the slowdown. And the Fed is also very aware of the risks. And I think they're going to be very attuned to those as we progress throughout the year.
Some economists said there are signs of stagflation in the United States. How do you think about it? Will stagflation appear?
Yeah, it's stagflation. I think it's important to define what stagflation is. If people are thinking this is going to be a repeat of the 1970s, when we had very high inflation, even higher than we have today, and high unemployment, I don't think that's very likely. Things were very different back in the 70s. The Fed has learned a lot of lessons from the 1970s, and they're very keen on not repeating those same mistakes. The other thing that happened in the 70s is that longer term inflation expectations were much higher than they are right now. The good news is that when we look at surveys of consumer inflation expectations, for price increases over the next 3 to 5 years, they're still actually, they're actually reasonably low, which is good news. That's very different than what we saw in the 70s. And then I guess the final point, the US economy in the 70s was also much more regulated than it is today. So it was more difficult for the economy to adjust to some of the shocks that were hitting it. There were wage controls, price controls. It was a very different economy than we have today. Today, we have a much more flexible economy, which makes it easier to adapt. So I think the likelihood of repeat of the 70s is not likely. But if you're defining stagflation as high inflation, higher than average inflation, and slower growth, that kind of is what we are going to see a version of that it's kind of happening now. And we do have slower growth and we do have higher inflation. We think that's more of a temporary phenomenon. Inflation will start to come down and we think we'll avoid a recession. But I just want to make a distinction. I think something from the 70s is very unlikely. But look, we do have high inflation now, higher than average inflation. And we do think that growth is going to slow down.
What are the consequences of stagflation if it happens? What should investors do?
Yeah, like I said, I think it's kind of happening to an extent right now. And I think the market is kind of telling you what works, right? In that environment, energy companies work, commodity prices, anything with anything that are what we call real assets that have some sort of inflation protection, those tend to work pretty well. So I don't think it gets any worse than what it is right now from an inflation perspective. I do think we're going to start to see a peaking out in inflation. It's basically happening right now. I think the bigger question is, how quickly does it start coming down? So, but I would stick to our recommendations. Having some exposure we do like commodities more broadly, having some exposure to the energy sector, having some exposure to some more defensive parts of the market, looking at value stocks, all that stuff makes sense. But I do want to underscore, I think I think the inflation pressures will start to get better over the coming months.
How do you think about the U.S. economy this year?
Yeah, as we've discussed, I think it's going to be slowing. That's really the whole point of the Fed rate hikes. The whole goal of the Fed is to slow down demand growth to get a better balance between supply and demand. And that will rein in some of these inflationary pressures. So it's going to be a little bit more choppy, even from the economy. It's going to be a more choppy environment. It's going to be choppier. We've seen obviously a lot of volatility in the stock market. And look, this is the key question: is whether or not we're going to have a recession or not. That is, we don't think we will, but we acknowledge that the risks are higher than average, and there is a risk that we do slip into recession. And that's going to be just the key question. I think it's going to be focusing on inflation. How quickly is it coming down? Focusing on the Fed. How much will they raise interest rates? And then, as I said, ultimately, how much does that slow down economic growth in the coming quarters? So I think those are the things to focus on as we think about looking out of the next 4 to 6 quarters.
Developed countries such as United States, UK, and Australia have all raised interest rates. What spillover effects will it bring? And how would this affect emerging markets?
Yeah, so traditionally, when developed market central banks are raising interest rates, that also tends to be a more challenging environment for emerging markets. And that's because the cost of borrowing money gets more expensive. Oftentimes, the US dollar and other developed market currencies are rising as interest rates are rising in developed markets. So it potentially has some spillover effects to emerging markets. Now, I think what's a little bit different these days is that most emerging markets are in pretty good shape. They've also been raising interest rates, so we don't think we're going to see the currency impacts aren't going to be as dramatic. In addition, a lot of countries have prudently managed their finances, so they don't have big external financing needs. So I don't think it's going to be a huge problem. Obviously, when we talk about emerging markets, it's a pretty heterogeneous set of countries. So each specific countries and specific companies within those countries are going to be impacted to varying degrees. But if I had to sum it up, it is a bit of an incremental headwind. The one thing here I do want to also highlight, though, is that China is a little bit. It technically is an emerging market in the indices that are traded around the world, but there are some very different dynamics happening in China. China emerging from recent COVID lockdowns, some stimulus being put in place. China has pretty deep domestic financial markets and access to capital. So I think it's important to make a distinction between China and the rest of emerging markets, and emerging markets more broadly. They're not in bad shape, but again, it's going to be very country and company specific. But there are some incremental headwinds from rising interest rates in the developed world.
Thank you, David. As David said, although there are plenty of headwinds that could put further pressure on U.S. equities, however, the Fed might still be able to manage soft landing. That's all for today's show. See you.